When it comes to investing, a lot of people are under the thought that put your money in the S&P 500 and that's the best way to go. It's very passive, it's very easy, and it's the greatest way to maximize your money. However, looking at some past historic performance, and don't get me wrong, future performance does not equal past performance. So keep that in mind, but just looking at how things have historically played out, dividend stocks and pretty much dividend initiators and growers have seemed to largely outperform the S&P 500 over the past multiple years, like 50, 60 years. They have been consistently outperforming. We're going to talk about some numbers and a lot of different things and why I believe dividend investing is the best way to go, whether that is strictly investing in your own dividend stocks and finding the best ones in your personal opinion, or just simply selecting dividend ETFs and all those different things. And this also is not me hating on the S&P 500. If you prefer to invest in the S&P 500, you've got to invest your money where you personally believe it is the best. You can't listen to other people. But let's go ahead and just get straight into it. Looking at the S&P 500 right now, doing semi-good over the past week, up 1.38% is actually pretty good on a week. But the past month, we're still down 8%. In the past 6 months, we're down 14.15%. In the past year, we're down just below 6%. So as you can tell, the S&P 500 has not been performing very well over the past few months and the past year, to be honest. I mean, if we go look at the 5-year, you can see a nice dip happening, We're starting to reach those levels of almost what happened in COVID, This is 16.27%. COVID was a lot more, it's 32%. But we're halfway there. Do I see that we will fall that far? To be honest, I have no idea. I don't have a crystal ball. I can't tell you. But let's go ahead and talk about how well does the S&P 500 usually perform. So on average, from 1957 through 2021, it has a historic annualized return of around 10.5%, which is incredible. 10.5 annually returned. That's very, very good. Let's go ahead and talk about the S&P 500's average dividend yield. Right now, it's approximately 1.3% through the end of 2021. But the long run average, since like the 1900s, even the 1800s, is roughly 4.3%. Historical yields for the S&P 500 have ranged from about 3 to 5%. Here's kind of what you get whenever you go from 1871 to 1960. The yields were very high. They were never below 3%. And then from about the 70s to the 90s, they were even higher at about 4%. And then going even further, they kind of started to dip to 1.9. And in 2008, they were very high, market crash, financial crash. And then they fell back down to about 1.97. And now they're sitting around 1.31%, as we saw, 1.3%. And lower yield dividends has kind of become the norm. But that's okay, lower yield dividends are still said to perform and historically have performed better than no dividends at all. So let's go ahead and talk about this. Here is dividend growth in times of turbulence, an article from last month, and you could say the market is in times of turbulence right now. Here is kind of how dividend ETFs and indexes have performed rather than whole indexes. The S&P 500 Dividend Aristocrats compared to the S&P 500 has performed only negative 3.01% compared to negative 4.6%. Mid-cap 400 Dividend Aristocrats in the S&P compared to non-dividend aristocrats in the S&P, only down 1.33% compared to down 4.88%. And the Russell 2000 dividend growth compared to the Russell 2000, only down 2.83% compared to a down 7.53%. So this kind of shows, even in downturns, these stocks are still going to fall. They're not indestructible, they're not perfect, but they're not falling as much. And not to mention, the dividends that you're getting are going to offset, So your stocks, let's just say for simple math, your stocks fall down 10%. Well, if you have a 3% yield, it's almost like you're only losing 7% rather than you're losing 10% of your money. So keep that in mind. But let's look at how dividends have performed. The S&P 500 Dividend Aristocrats Index, and remember, a Dividend Aristocrat is a company that has been paying their dividends and increasing their dividends every single year for the past 25 years. So for at least 25 years. This index has an annualized return of about 18.3% over the past 10 years. And this is from 2019. So this is going to be from 2009 to 2019 compared to the S&P 500's 17.1%. That's a 1.2% difference, which is pretty big, And one thing I kind of wanted to mention was a lot of people are talking about with interest rates rising, are bonds like the way to go, are bonds the move? And this is kind of a different interest rate economy, but looking at some 10-year treasury bond yields compared to Procter & Gamble and Coca-Cola, the yield on bonds for the 10-year treasury bond was about 2.59%, Procter & Gamble about 2.8%, and Coca-Cola had about 3.5%. And there's dividend stocks out there with lower yields, with higher yields. You got to find what fits for you, Let's go ahead and talk about some more stuff, which is just getting even more and more intense. Now we have Dividend Kings versus the S&P 500 index. And a Dividend King is a company that's been paying and increasing their dividends every single year for the past 50 years. That's a 5 and a 0, 50 years. Here's a list of some, if you want to take note, you can screenshot this. I'll leave it right there for a second. You can screenshot it. Go ahead and do that. Kind of get all the list, all the stocks. These are some Dividend Kings. But let's go ahead and look on some key statistics about this. So performance comparison. In this little experiment they did, they took $3,000 invested initially at the start point of 1999, adjusted for inflation. They put that $3,000 in this portfolio and did not touch it. They did not put any more money into it. They did not take any money out of it. So let's go ahead and talk about this. Portfolio 1, which consists of the 29 Dividend Kings, has a compound annual growth rate of 24.7%, whereas the S&P 500 had a compound annual growth rate of 22.9%. Okay, that's almost a 2% difference, which is pretty large, So here is this $3,000 growth. Here it is visually. Orange line is going to be the S&P 500, and the purple line is going to be Dividend Kings. You can just see the growth kind of expanding and getting wider and wider as time goes on. If you did invest this $3,000, reinvested dividends, all these different things, you would have ended with $302,271 compared to $224,365. That's almost an $80,000 difference, which is very big. The internal rate of return for the Dividend Kings was 11.6%, and for the S&P, it was about 9.2%. So these are very big numbers. Keep that in mind. And here is kind of a study case that I always show on my channel. I haven't showed it in a little bit, but this is very important in my personal opinion. Here's the power of dividends and compounding. This is kind of just the power of reinvesting dividends in this example, but 84% of the total return of the S&P 500 can be attributed to reinvested dividends and the power of compounding. Here's a growth of 10K from 1960 to 2021. With the S&P, no dividends, $795,000 compared to reinvesting your dividends, you're going to get $4.95 million. That's a massive gap, okay? And here's kind of a little example, as we talked about the S&P comparing not as well in downturns as dividend stocks. Total return for the S&P was negative for the 2000s. It was a lost decade, the tech wreck, the 2008 financial crash, things like that. But dividends provide a 1.8% annualized return over the decade. So it's very good, especially in bear markets, to have dividends coming in. As we saw, dividend yields have been falling recently, and the trend has kind of continued to fall. But this is mainly, this little dip right here is also inclusive of COVID. So that did play a large role, but even as dividend yields, if they do historically fall, if you find the right stocks, you're going to be okay. And kind of speaking of not chasing just the highest yield, the study that I'm about to show you guys, found that stocks that paid the highest yield did not perform the best. It was stocks that paid a good yield and not anything that was out of insane high yields. So here is the second quintile stocks. These people paid in return the best. Second quintile, if we look at their payout ratio, let's go ahead and see right here. Compared to the first quintile, had a payout ratio about 74%, and the second quintile had a payout ratio of about 41% on average from 1979 to the end of 2021. And here's just kind of, I'll show you this real quick. I'm going to scroll down and show you the average returns of these kind of different groups. Dividend growers and initiators had the best returns compared to dividend payers, companies with no change, non-payers, people who cut their dividends, and the S&P 500. Dividend payers also had a higher yield, had a higher return than the average for the S&P 500. Now here is this little example, okay? Return to the S&P 500 compared to dividend growers and initiators. This is a growth of $100 from 1973 to 2021. The S&P grew to $4,744. Dividend payers almost doubled to $8,942. And dividend growers and initiators really made it up there to $14,405. So these are the kind of returns that we're seeing right now, which is pretty big. And as we saw, we talked about bonds a little bit, but yields are continuing to increase over the bond yields, and investors are seeing this as a good opportunity. So historical performance does kind of show dividend stocks, and especially dividend growers and initiators, have performed far better than the S&P 500. So keep that in mind. You know, it's kind of one of my main theses for why I do invest in dividend stocks. But remember, past performance does not guarantee future results. Always, make sure you're doing your own research, all that good stuff. But if you did enjoy this content, make sure to subscribe to the channel, turn on post notifications so that you don't miss out on any future videos. We've got a big announcement coming up very soon, waiting for it to all be finalized and ready to go. Stay tuned for that. Check out M1 Finance using the link in the description down below and all that good stuff. And I will see you at the next video.